Welcome to the Deep Dive. Today we are cutting through all the noise to get to the core story from Penguin Solutions, that's ticker PENG. This is all following their Q1 fiscal year 2026 earnings call, which dropped after the bell yesterday, January 6th.
Exactly. And our mission today is, well, it's pretty straightforward. We're here to pull out the critical financial signals, break down their new strategy, and maybe most importantly, figure out why the market reacted so well, sending the stock up in after hours.
Yeah, it was a really constructive move.
It was. This wasn't just another earnings report. This was, I think, the quarter where management finally sort of cleaned up the past and went all in on AI.
Okay, so let's unpack that right out of the gate. The numbers. The ones that, frankly, seemed to shock the street a little.
It really did.
Because when you look at these Q1 results, the big takeaway for me is that management delivered results that held up so much better than anyone expected, especially given the massive headwinds they were facing.
Absolutely. The bottom line was the huge surprise. Non-GAAP diluted EPS came in at a really strong 49 cents.
49 cents. And the street consensus was what, 41?
Only 41 cents. So that's an 8-cent beat. That signals, real execution, margin durability, tight cost control. That's the first thing investors saw.
Right. Now, on the top line, there was that modest miss, which surprisingly the market just seemed to shrug off.
It really did.
Revenue was, what, $343 million?
$343.07 million, just shy of the $345 consensus. But even with that, they still managed to post some growth, up 1.5% year over year.
And that 1.5%, that's actually the heroic number of the whole quarter, isn't it?
It absolutely is. I mean, look, if you miss revenue by $2 million, but you crush earnings and you prove your margins are solid, the market sees a successful turnaround play. They're giving management a ton of credit for steering the ship through some really serious turbulence.
Which brings to the question, what was that turbulence? And how on earth did they navigate it while keeping gross margins that strong?
All right, let's start with the margins. Non-GAAP gross margin came in at a solid 30% for the quarter. To hold that line while you're actively getting rid of old businesses, that is seriously impressive.
It is.
But to really get it, you have to look at the segment breakdown, because it's a story of kind of hiding incredible growth behind some very visible decline.
Okay, let's dive into that segment story.
So integrated memory was the undisputed star. Just a monster quarter, up 41% year over year in net sales, hitting $137 million.
Wow.
Massive demand validation. Meanwhile, you've got advanced computing, or AC, which on the surface look, well, weak. Net sales of $151 million, down 15% year over year.
And that 15% AC decline, it looks terrible in a vacuum. Is there any silver lining there?
Oh, there is a huge silver lining. And management went out of its way to give this context. They said AC sales, excluding the parts they're actively winding down.
The old stuff.
The old stuff, exactly. The hyperscale hardware from last year and that Penguin Edge business. Excluding those, AC actually grew 52% year over year.
52%.
That's the real growth story. That is the new focused Penguin Solutions.
So they were essentially cleaning house while trying to grow the main business, and all that cleaning was just dragging the headline number down.
Precisely. And they quantified the pain for us, which was great. They estimate the combined hit from those two wind downs was about a 14 percentage point unfavorable impact on total company net sales growth.
Wait, hold on a second.
Yeah.
They overcame a headwind equal to a 14% revenue hole just to post 1.5% growth.
Yes.
That completely changes how you have to view this quarter. This wasn't just a beat. It was a successful structural replatforming in real time.
That's it. They absorbed a 14-point headwind and still delivered a positive number and that big EPS beat. The only real weak spot without an excuse was Optimize LED. That saw net sales of $55 million, down 18% sequentially, mostly due to softness in China and some issues with a big U.S. customer. But really, the focus is all on that strategic cleanup.
And that cleanup, it speaks to their financial discipline, too.
Yeah.
Let's talk about the balance sheet for a second, because this stability gives them so much optionality for the bet they're making on the second half.
It really does. I mean, they're basically net flat on debt. That's crucial. Cash stood at $461 million against about $462 million in total debt. And on top of that, operating cash flow was really robust at $31 million, which led to free cash flow of about $28 million for the quarter. That cash cushion is the foundation for this whole strategic pivot.
Okay, so this is where the story shifts. Zooming out, what does that strong foundation let them do? Management is making a fundamental change in how they see the AI market.
They are. They're seeing this big acceleration toward wider enterprise adoption, production scale stuff. The market's moving away from that early phase of just, large language model training at the hyperscalers.
So the big money is no longer in just teaching the AI, it's in actually using the AI.
That is the simplest, best way to put it. Training is teaching. Inference, which is what they're focused on, is when the AI actually gets put to work in the real world, answering queries, running internal systems, you name it. And when you move into production, things like performance, reliability, bandwidth, they become absolutely critical. And that plays right into Penguin's historical strengths.
Right, and Penguin is positioning itself as the go-to partner for building that enterprise AI factory. They're leveraging, 25 plus years in high-performance computing? They're selling reliability, not just racks.
It's the full stack solution. The infrastructure, the specialized software, the orchestration, all that deep technical know-how you need to manage the crazy complexity of AI at scale when you're not a hyperscaler.
And the proof is already showing up in the pipeline, which for me was the most exciting part of the call. They've got new customer wins in defense, education, research. But the near-term wins are even more concrete.
Oh, yeah. They explicitly said they've secured master agreements with a major financial institution and a major oil and gas customer. And they expect the purchase orders, the POs, to land shortly. This is exactly the kind of customer diversification investors wanted to see.
It totally moves them away from that old lumpy revenue customer concentration problem they used to have. They also mentioned they're in talks with sovereign cloud customers outside the U.S.
Right, for these huge, large-scale AI deployments, which just reinforces the need for their kind of rapid deployment solutions.
And to support all this, they're not just selling hardware, they're providing tools, like this Rapid Development Workshop program.
Yeah, which is basically a consulting service to help customers plan for scaling AI. And they're customizing their ICE clusterware software to be compatible with other open source stuff, which makes the whole infrastructure more robust and flexible for these new massive deployments.
So while the AI pivot is the big headline, we can't ignore that integrated memory segment. It absolutely crushed it, growing 41% year over year. What's driving that? What's the tech story there?
Well, the demand signals are just intense across networking, telecom, computing, all of it. But the innovation here is all about solving a huge pain point in AI systems. Memory bandwidth.
The bottleneck.
The bottleneck, exactly. It's that choke point where you can't get data to the CPU or the GPU fast enough to keep up.
And their answer to this memory constipation is CXL, right?
Exactly. Penguin is an early developer of Compute Express Link, or CXL, solutions. You can think of CXL as a new, super high-speed, open standard interconnect. It lets processors pool and share memory, which dramatically increases speed and capacity. And they're already shipping early production units through their OEM partners.
And they're looking even beyond CXL at optical interconnects.
Yeah, that's their long-term bet. They're continuing to invest in the optical memory appliance, or OMA. It uses a photonic light-based transport layer to boost performance even more. And the best part, management sees all the recent M&A in the optical fabric space, Marvell buying Celestial AI, as huge validation that they're on the right track. They think their 30-plus years in specialty memory puts them in a perfect spot for the AI era.
Okay, so we have a resilient Q1, a successful cleanup of the past, and a strategic pivot that's already landing customers. How does all this translate into the full-year guidance? Because that's what the market is betting on now.
Management confirmed the full-year outlook, revenue between $1.3 and $1.6 billion, and non-GAAP EPS between $1.75 and $2.25. The key here is just stability. Q1 was strong enough to hold that forward view.
But that guidance is heavily backloaded, isn't it? They're calling for a big second half.
That's the whole bet. The full-year guide assumes a heavy H2 weighting. A huge chunk, 53 to 54% of total net sales, is expected in the second half. It all hinges on those AI opportunities in the pipeline, especially those new financial and energy deals booking and shipping later this year.
And this shifted mix has affected their margin outlook just a little bit, right?
It has. So the good news is they raised the memory growth outlook to 20 to 35% year over year. The trade-off is that memory has a slightly lower gross margin. So the full year non-GAAP gross margin outlook was lowered by about 50 basis points to 29%, give or take. It's a classic trade-off. A little less margin today for a lot more revenue and growth tomorrow.
And finally, let's touch on capital allocation. They're cleaning up the company structure just like they cleaned up the business segments.
That's a great way to put it. They're focusing on the core by selling off the other assets. They announced the sale of their remaining 19% stake in Zilia, their Brazil memory op, for about $46 million. That should close in Q3. This isn't just a cash boost, it's management signaling a laser focus on their core strategy. Plus, they bought back $15 million worth of their own stock in Q1, reinforcing confidence.
That sets the stage perfectly for our final segment. Let's talk about how to capitalize on this very specific moment in time. This is not financial advice. We are analyzing the mechanics of capital and market perception for intellectual consideration only. You are solely responsible for your own investment decisions. This is an exploration of market signals and nothing more.
And with that very clearly established, let's explore that outrageous but plausible pitch that takes advantage of the specific balance sheet timing.
The market is clearly betting that management can execute on that H2 AI pipeline. The consensus price target is already floating around $28. So the question is, how does management give the stock an immediate, aggressive catalyst right now?
They've got the cash. They've got the firepower.
Yeah, absolutely do. Management is sitting on $461 million cash, and they're about to get another $46 million from the Zilia sale. The current buyback pace is it's too slow for that kind of cash position. We need an acceleration play.
So what's the move, the tactical move?
I want them to execute a highly accelerated, fixed price tender offer for outstanding shares. And they need to do it immediately. A massive immediate reduction in the share count, the denominator, before the bulk of that H2 revenue and earnings, that 54% of sales, gets recognized.
So by shrinking the share count right before your biggest earnings period, you amplify the resulting non-GAAP EPS. You're basically engineering a stronger earnings print for the back half of the year.
Exactly. It forces an immediate aggressive re-rating of the stock. It makes the high end of that $1.75 to $2.25 guide so much easier to hit on a per-share basis. A big, well-timed buyback like that gives you a massive catalyst that validates a long position or maybe a bullish call spread strategy. Targeting that $28 target right now, it's management using its balance sheet to pull forward the benefits of their H2 execution.
That is a fascinating, aggressive pitch. It capitalizes perfectly on their liquidity and the timing. So to recap the whole story, Penguin Solutions delivered a critical non-GAAP beat. They navigated a tough structural cleanup, and they held their full-year guidance. The pivot to enterprise and sovereign AI, backed by strength in memory and tech like CXL, it gives you that essential growth visibility.
It's all about execution now, pure and simple.
And that leads to the final provocative thought for you to consider. The entire guidance now rests on them converting those new customer agreements, the financial deal, the oil and gas deal, and getting those POs in Q2. If they secure those large new customer deals, what impact will Penguin's long history in designing, building, deploying, and managing these complex high-performance systems have on securing follow-on business, turning these crucial new wins into durable, multi-year, sticky contracts? That ability to lock in long-term enterprise revenue, that's the real upside of this whole pivot.
That's where the real value gets created. And that's all the time we have for this deep dive. We'll catch you next time.